today, end of financial year coming up, what should you be thinking about? Hello again, it's Martin North from Digital Finance Analytics, where I notice posts covering finance and property news with a distinctively Australian flavour. Well, here we are getting up to the end of June, and there are some important questions that you need to be thinking about. I have Sam Kerr from Nucleus Wealth joining me today to discuss this. Hi Sam, how are you going?
Good, thanks Martin. How you go?
Yeah, pretty good. And this is an important time of year, 3 or 4 days left. And some people think, oh, it's very complicated. But actually, there are some very important decisions that people need to make sure that they maximise their position at the end of this financial year with regard to savings.
Yeah, that's right. So I just wanted to talk about concessional contributions today and the tax benefits. It's obviously getting close to the end of the financial year. So it's a good opportunity to get some more money into super in a tax-effective way. And boost your super and get it growing.
And I guess the point there is that this time of year there's a lot of other things going on, but this is an important thing to think about, right? Because you've got this really limited window to be able to do things.
Yeah, so end of financial year is coming up very shortly, and for concessional contributions for this year, it has to land in this financial year. So it's important to get your money in before the deadline.
All right, well, let's talk about the limits, because the other thing to bear in mind, there are some very important limits that you've got to think about, right?
Yeah, that's right. So firstly, I'll just explain what catch-up contributions, what concessional contributions are, and then we'll touch on catch-up contributions as well. So a concessional contribution, it's a pre-tax contribution into super. So instead of paying tax at your marginal tax rate, you pay tax at the super contributions tax rate, which is 15%, and you get the tax saving. And then your money gets into the low tax environment of super as well. And I just want to take a moment just to help your viewers understand the benefits of superannuation and why you actually want to get your money into super. So I mentioned before, it's a low tax environment. So any earnings within super are taxed at a maximum of 15%. And then, capital gains, if it's held for less than 12 months, tax at 15%. If you've got capital gains held for longer than 12 months, it's taxed at 10%. But the main benefit of the superannuation environment is when you actually retire, when you're in pension phase, it's a completely tax-free environment. So there's no tax on any earnings, no tax on any capital gains, no tax on any withdrawals. That's why you want to get your money into super, because it's a tax-free environment when you actually retire.
Right, and that's very important for people to think about. You've got to think long term rather than just what's happening next year. You've got to think into the future, but it's a pretty important thing. But you mentioned the contributions, and there are some particular things people need to be aware about with regard to those eligible contributions.
Yeah, so at the moment, in this current tax year, 2021, 2022, there is a limit on the amount of concessional contributions you can get in. So the yearly limit is 27,500. And in some of the previous years, that came in 1st of July 2021. But previous to that, it was 25,000 per year. It is indexed to go up, but there's no set date at the moment. You don't want to exceed that limit. Otherwise, you'll incur Division 293 tax. You want to be mindful to stay within the limit.
And just to be clear, when we talk about eligible contributions, right, there's some different sort of structures around it.
Yeah, that's right. So there's 3 different types of contributions, concessional contributions that you can utilize. So firstly, there's the SG contributions. So that's the 10% that your employer is legally bound to put into your super on your behalf. So 10% of your income. So at the moment, that's 10% in the 2021-22 tax year. But as of 1st of July 2022, so very shortly, that's legislated to go up to 10.5%. And then 1st of July each year going forward, it goes up by another 0.5%. Until the 1st of July 2025. Then it'll be set at 12% of your income that your employer has to put in. And there's it's not intended to change from that. So it's intended to be set at 12% going forward. So yeah, 10% at the moment, going up to 10.5% on the 1st of July this year, 2022. So that's the SG contributions. Then we've got salary sacrifice. So that's an arrangement between you and your employer. And your employer deducts some of your income on your behalf and puts it into super on your behalf. So that one, it reduces your taxable income and reduces your take-home pay, but boosts up your super and reduces the overall tax you pay. So that's salary sacrifice. Then we've also got personal deductible contributions. So that has the same net effect as salary sacrifice, but instead of spreading that out over each pay, you can just put in a lump sum and then claim a tax deduction on that. So there's a few different things that you need to do to fulfill the requirements of the personal deductible contribution. So once you actually make that contribution, once you put that lump sum in, you have to lodge what's called a notice of intent to claim a tax deduction. So you put that form in, but the most important thing is you've got to put the money in this tax year. So it has to land in your super fund this tax year to count towards this year's cap or limit. So once you claim, lodge the notice of intent to claim a tax deduction, then you'll receive an acknowledgement from your super funds. And you give that, you can use that to claim the tax deduction. So the difference between your marginal tax rate and the super contributions tax rate, you can claim that tax deduction when you lodge your tax return, or just give it to your accountant and they'll claim that tax deduction on your behalf. So yeah, those are the three ways you can get money into super with the concessional contributions.
And those other limits we spoke about, got to make sure you keep within those. And it's interesting, you can actually, because I run my own self-managed super fund, so I actually write myself a letter, right? Basically saying I've made a contribution in, and I have to fill in the form from a self-managed super fund, and I have to advise myself that I've actually put the money across, right? Because the self-managed super fund is a separate entity to my personal tax affairs. So you have to do both sides if you're running a self-managed super fund.
Yeah, that's right. So next thing I want to talk about, Martin, is if we can just pull up that slide with the tax rates, showing the marginal tax rates. So like I said before, you get the benefit of the tax saving between your marginal tax rate and the super contributions tax rate, which is 15 cents in the dollar. So you can see here, as your income increases, the greater the benefit is, because there's a greater saving from the difference between your marginal tax rate and the super contributions tax rate. So if you're earning over 18,200, well, below that level you don't pay any tax, but between 18,201 and 45,000, you're paying 19 cents in the dollar plus 2 cents Medicare levy in the dollar. So you're paying 21 cents in the dollar. So anything over that amount, just a small disclaimer, we're not taking into account the low and middle income tax offsets. So there's an effective tax-free threshold that's slightly higher, but for this, we'll just keep it simple. So anything over 18,201, you're going to be paying effectively 21 cents the dollar, including the Medicare levy. So minus the 15 cents contributions tax rate into super. So you're getting a 6 cent tax saving for every dollar you put in. And then it obviously goes up each band. So the next between 45,001 and 120,000, you're saving 19.5 cents in the dollar. Then the next bracket, you're saving 24 cents in the dollar for each dollar you put into super. And then if you're earning over 180,000, you'd be paying 47 cents tax in the dollar, including the Medicare levy. So putting money into super and only paying tax at 15 cents in the dollar, you're saving 32 cents for every dollar that you put into super. So you can see there's a lot of benefit for getting your money into super, the tax savings. And then it's in that low tax environment, which is more likely lower than your marginal tax rate. So yeah, it's a great place to save for your retirement.
Yeah, absolutely. And again, it's you do that every year, and it accumulates year after year after year, and you end up then with a nice tidy sum, so that when you actually move into retirement and move into that retirement phase, you can draw it out. And as you said earlier on, that's a tax advantaged position, isn't it?
Yeah, absolutely. I mean, it's a huge benefit that it's a completely tax-free environment and pension phase. Compared to having those investments outside of super and paying tax at your marginal tax rate. It's a great place to save for your retirement.
Now, did you want to go through the specific example, or did you not?
Yeah. Let's run through an example. We can see here, let's say someone earns $100,000 a year. Your employers put the 10% in on your behalf, the SG contribution. So that's $10,000 per year. So the concessional contribution cap at the moment, $27,500, like we mentioned. So you can either salary sacrifice or make a personal deductible contribution of $17,500 to bring you up to that yearly limit. So on 100,000, you pay $23,767 in tax, including a 2% Medicare levy. So a really great calculator, tax calculator, is paycalculator.com.au. So you can put in lots of different scenarios in there and see the amount of tax that you pay. So let's say we put in the full amount, $17,500, that concessional contribution. So that reduces your taxable income from $100,000 down to $82,500, and reduces your income tax payable from $23,767 to $17,429.50. I know this is a little bit complicated, but just stay with me here. So you've got an income tax saving of $6,337.50. But that's not the full story, because you have to pay the super contributions tax of 15% or 15 cents in the dollar. So on that 17,500, that'll be $2,625. Therefore, the net amount contributed into super is $14,875. And so overall, you've paid $3,712.50 less tax. You've got an extra $14,875 into super, and plus your money's in that low tax environment of super to grow more tax effectively than investing outside of super. So does that make sense, Martin?
No, absolutely, and I think that's important for people to understand, right? So effectively, you're reducing your effective income threshold, and that means that effectively you end up paying less tax, but you have to offset that by paying a little bit of tax in the super environment, because they're a different tax rate. Super environment is super efficient when it comes to tax.
That's right. So we've sort of hope we've explained how the concessional contributions work, but there's also what's called catch-up contributions. So these were brought in from the 1st of July 2018 for the 2018-2019 tax year. If your total super balance is less than 500,000 and you haven't utilized your full concessional contribution limit for each year since that year, you can effectively catch up those contributions. So you can top up to your concessional contribution limit. It's on a rolling 5-year basis. So for the previous 5 years, back to 1st of July 2018, any unused limit you can actually put in this year or the next year as a lump sum contribution. We'll talk through a worked example again in a moment, just so we can make it as clear as possible. But to actually see how much available catch-up contributions you've got, you can log into your MyGov account, go to your ATO section, and that'll show you how much available yearly limit you have left, and then also how much catch-up contributions you have available on that rolling 5-year basis. You can make these catch-up contributions either as a personal deductible contribution, or you can do it as salary sacrifice. But more often than not, people do a personal deductible contribution for this one because it's easier to do a lump sum if you know how much you've got available. The great thing about this is it really gives you a lot more flexibility around getting money into super. So if you came into if you got an inheritance, for example, you came into a lump sum, you might have sold an asset, a property, some shares, and have a good chunk sitting there. You can take advantage of these concessional catch-up contributions and get all the benefits of the tax saving of it as well. And just another little tip is it's a good way to reduce your capital gain. So if you've made a substantial capital gain in this tax year, you can put that money in to reduce, again, instead of paying tax at your marginal tax rate, you're paying it at the super contributions tax rate of 15%. That's effectively how the catch-up contributions work. Is that all clear, Martin?
That's pretty good. And you've got a worked example too, which we'll put up now because it actually helps to make it a little clearer, I think. So let's put it up.
Yeah, that's right. So you can see from 2018 to 2019, the concessional contribution limit was actually 25,000. And it was 25,000 right up to 2020, 2021. So, and previous to that, your employer was mandated to put in 9.5%, not the current 10%. So let's say you earn 100,000 per year. Your income hasn't gone up since 2018-19, so that's just the same each year. And you've only made SG contributions, so only employer contributions have gone in. You haven't utilised any of the concessional contributions. So you can see 2018, 2019, your employer put in the 9.5%, that's 9,500. So you've got unused concessional contributions of 15,500. Then same thing from 2018, 2019, right through to 2020, 2021. But you can see over on the right-hand side, each year, those unused concessional contributions accrue. And then in the 2021-22 tax year, in this current tax year, you can see the concessional contribution limit's now 27,500. And the SG contribution rate from your employer is now 10%. So your employer puts in 10,000 per year. So unused contributions are 17,500. So your total unused concessional contributions would be $64,050. So if we jump over to the next slide, I'll try talk through as best I can. So like I said, $64,050 you're able to utilize for your catch-up contribution. So at the moment, it'll reduce your taxable income from 100,000 down to 35,950. So that's reducing the tax that you pay, your income tax, from 23,767 down to $2,716.50. So that's the tax payable on that $35,950. So that's an income tax saving of $21,050.50, including the 2% Medicare levy, because you don't pay that 2% Medicare levy when you put that money into super. So that's just a little additional saving as well. But you have to pay the super contributions tax rate of 15%. So on that $64,050, that's $9,607.50. So therefore, the net contribution into super is $54,442.50. So that's the $64,050 minus the 15% contributions tax of $9,607.50. So overall, you've saved $11,443 tax. And then again, now your money's in that low tax environment with super. It can grow more tax effectively. And then once you actually go into pension phase, it's completely tax-free.
Yeah, thank you for that, Sam. And, it sounds a bit daunting and complicated, but actually, once you walk through it, you realise it's not that complicated. And I guess we should underscore that this is just a general conversation. This isn't specific advice. Everybody's individual circumstances are different, and they need to go and get specific advice to make sure that they're making the right decision. But these are just some basic principles that help to guide that.
That's right. Yeah. So always seek specific tax advice, and always go and talk to your financial advisor about your personal situation. But,
just to underscore, there's a window of opportunity up to the end of this tax year, right, to be able to maximise the stuff that's there. And of course, when you say maximise, it's simply because those are the rules. And if you work within the rules, then there's nothing wrong with doing that at all. It just makes sense, actually, to reduce your tax where you can.
That's right.
Sam, thanks very much. We'll put some links and things below as well. And great talking to you. And we'll hope that everyone will plan their end of financial year to their best effect. Thank you very much.
Thanks, Martin. Cheers. Bye.
Bye.